Here is the chart. Well, okay, it's not cluttered here, but here is a clearly drawn resistance. Then below it, support, support, support. And here further goes the description. Definition of market structure and boss break of structure. The price's upward movement reached a peak, made a reversal, and blah blah. It created a bunch of lower highs and so on and so forth. Simply put, a series of peaks. Descending lower peaks indicates that there will be a breakout of support and further decline of the instrument somewhere here. It's that simple. Why complicate it? Just say this further. FVG and liquidity void. Liquidity gaps on this time frame between the candles of November 7th and November 7th, as well as November 8th and 10. Why is this needed? Let's just look at the gold chart. Without delving into any November 7, 20 or 10, and what liquidity zones, I don't even know what those zones are. I honestly don't understand what is being discussed. And I will tell you, I don't want to understand it, I don't want to know it, it's not necessary. Again, there was resistance here, the resistance area was broken, there was a classic pullback to the broken area, and further movement. Here we see a breakout again of the maximum, a return to it, an attempt to bounce, but it was broken, and then it fell and found support somewhere near previous levels. It's all quite simple, right? Here you look at the chart and understand perfectly. Thanks to, for example, the simple fact that it just bounced off the 100-day EMA of gold, the next potential support will be somewhere around 200. That is, when it reaches, this 200 can be here, it can be there, no one knows. But it depends on the time period. Nevertheless, we can clearly see the chart itself shows where there are resistance zones, where there are support zones, and so on. Tell me, what's the point? External liquidity is located in the lower area. I don't know what external, internal, outer, or any other liquidity is. I don't want to know it. Nobody needs that. In fact, understand correctly, the essence of this video is not to say that this is bad. If you have, let's say, an academic mindset and you want to delve into something, learn, and grasp something new, that's great. Go ahead, learn. If you want to know 20 indicators, excellent, you'll know 40 indicators. If you look at TradingView, how many of these indicators are there and how necessary are they? That's quite a question, as they say. But nevertheless, it's good if you've mastered some indicator. And thanks to it, you're making money. That's great. If you can also make money because you know 10 indicators, that's also excellent. But in most cases, as a person with experience, I tell you that these indicators are not needed by anyone at all, really, because where buying will occur is already visible by the support levels and areas, and where selling will occur, where the resistance is. And if there is growth in an empty field, as they say, then there are the tools. You can also approximately forecast something there. I'm saying you can take the simpler path. There are my RSA and wave analysis. This is excellent analysis, and it also shows its advantages, so to speak. You can use Fibonacci levels and so on and so forth. This is all good, but cluttering all these indicators, which you know, onto one chart, so that the chart itself, which already carries enough information, what is the point? In an old song, when it was sung, and this is exactly what I would like to conclude with, why make complicated what is as simple as can be?